cool. We can just keep talking.
Okay.
And then now, let's see, there it goes. All right. Cool.
It's funny how you have to always keep your background clean.
Right? And then like all my mess is like right here in front of me. It's like, as soon as it starts like pushing things off so nobody can see it.
Yeah, today was one of those days, just way too much stuff going on.
Yes, yeah. I mean, do you have a lot of requests nowadays?
You know, my latest request was for me to step back into this scoreboard.
Oh,
I'm like,
oh, I feel for you.
so that should be a big enough request. I don't want any more.
Exactly. Oh my goodness. All right. So now I don't know where my slide go.
Must be a Wednesday.
It is. Do you see my slide?
I see your Facebook.
What? Oh, okay. How about now?
Yes, I see your slide.
Oh, good. Oh my gosh, I was like, why is it my Facebook? Okay, I guess I need to trim it later.
That's why I close down all my other screens, because then I know that there's only one screen I can share.
That's right. Hey, Anthony. Hello. Oh,
Whoa, are you recording? I'm sorry.
no, it is on YouTube live right now. So it's 4:01. I need to go ahead and start the webinar. But are you ready, Michelle?
Yep.
All right, let's do it. All right, welcome everybody to our Bay Area Housing Market Town Hall. Today is one of those days Michelle and I were both just like, oh my gosh, it was just crazy. And then also we realized that it's 4 p.m. and apologize, we started a little bit late, but I'm really excited. Today is already our 39th episode for our Bay Area Housing Market Town Hall. Again, there's just so much going on in the last 3-4 weeks since last month. But today I'm so excited. Michelle is going to be talking to us about most people probably been thinking about is the fire insurance, flood insurance, and earthquake insurance. And I know, Michelle, we talked about this, like really, if we need to talk about all of that, it's probably going to take a few hours. But we'll try to squeeze it in. And on top of that, we're going to have our housing market update as well. All right, let's get started. All right, so as always, I want to invite you guys to join us on YouTube. We are doing live stream right now on YouTube. Please do subscribe. I'm so excited. A lot of you have subscribed to our channel last month, and we now surpassed 1,000 subscribers. I have no idea why it was such a big thing for everybody who's like, oh my God, you have reached 1,000 subscribers. I'm like, what's the big deal about this? But apparently it's a milestone. So thank you so much for all the supports, and then we will continue to produce educational information for you guys so that you can be educated in the real estate market. And of course, we added YouTube Shorts because we now understand that people's attention is not as long anymore. They want something that's 30 seconds or 60 seconds long. So we added these shorts. So we do have the longer versions, and we do have some shorter versions for you to watch as well. And if you feel like this is just way too overwhelming, just go to our website, halengroup.com. We try to organize everything on our website so it's easier for you guys to navigate. Now, don't forget, we also have Facebook, Instagram, TikTok, and also LinkedIn. So please do follow us on social media so we can keep you guys posted what's going on with Halen Group. Now, let's start with our the month of February, our housing market stats. there's so many things that we want to share with you, but really last month, I'm sure everybody had experienced some kind of storms, and the rain is still kind of keep coming in and out for a little bit, which is really exciting because we haven't seen so much rain for so long now. But because of the rain, our housing market in January was definitely a lot slower. Typically, most of the time, or most of years, that January 1st start, we see buyers start to come out, start to look at properties. But I would say the first 3 weeks of January, it was really, really slow. And it was so slow that it was even on the market, on the news that talk about how slow the market was. But things started to change. And then let's just look at some of the statistics for the month of January. So in terms of active listings, the inventory is still quite low. We don't see a huge jump on the inventory. Well, that's expected. Typically, buyers are ready first, but sellers start to get their properties ready after January 1st. So it takes them about 2 weeks to maybe even 4 weeks to get their properties ready before they hit the market. So we typically will see active listings probably increase a lot more in the month of February. And on top of that, if you look at number of active listings versus number of sales, and you still see that there is quite a bit lower of in terms of the number of sales in January, because the market just so slow in December and January. Even though we already have very low listings, we don't really have a lot of listings compared to last year. As you see, we peaked over almost 9,000 units, but at the same time, because buyers just really at this moment where they're not sure where the market's going. On top of that, even though 2023 started, the rain had really stopped them from coming out to look at property. So that's why you see that the number of sales versus number of active listings has such a wide gap. And in January, again, as we mentioned, a lot of buyers are not coming out. So you see that month of inventory has shot up to 2.4. But again, I am reminding everybody over and over again that normal market for month of inventory for a normal market is 4 to 6 months. So 2.4 months is still not a bad number. It's still actually pretty good. Although we're not used to it, because for many, many years, we've been seeing around 1.2 or 1 month of inventory. Things just move really fast, but 2.4 is still a relatively fast market for a normal market. All right, so what about the days on the market? We have gone through, again, like we mentioned just now, about 1 week, less than 2 weeks time frame to get the properties under contract. Now it has gone up to, in January, it was 28 days. So in January, definitely even longer than December, which is really rare. Again, go back to the rain, blaming on the rain, but then we do need the rain. So I'm not really complaining about it. I'm glad that we have the rain. It's just that it did affect the housing market a little bit. And in terms of the sales price to list price ratio, we've seen as high as 14% last year in April, and then it had started to come down slowly every month down to 99.4% of the asking price. So definitely during the last 2 months, December and January, a lot of our buyers were able to actually negotiate down the price to get it under contract below asking price. And in terms of how many listings withdrawn or canceled, these are typically happens when the seller is like, oh, forget it, I'm gonna just give up, I'm not gonna sell anymore because maybe it's not moving, or maybe they feel like the timing is not right. So they will withdraw for now or cancel the listing. So, but we see that in the month of January, actually, the number of canceled and withdrawn has come down quite a bit compared to December. But December, of course, a lot of times, if the property is not sold by maybe beginning of December, a lot of sellers would decide that, hey, I'm gonna take the listings off the market until the next spring or until next year when the market comes back up. So this is the reason why you see that there's quite a bit much higher in terms of withdrawn and canceled in the month of December, and January typically we have much lower numbers. But if you compare to last year, our numbers kind of went back to about like month of April, which I thought is pretty interesting because the month of April was a very, very hot market back then in April, and January Well, I would say also our inventory is not as high, so that's why we have less number of withdrawn listing and canceled listings. All right, in terms of list price decreased, we are pretty much similar to the month of December in terms of the list price decreased. A lot of not as many compared to September, October, November. Main reason is because that a lot of sellers are a lot more realistic now in terms of asking price, and they've learned that if they ask way too high, the property is just going to sit on the market. And hopefully, this is what most of the realtors are advising their clients, and not to expect such a high price, because right now a lot of buyers are expecting sellers to reduce their price before they would make an offer. So a lot of times, like, sellers would try to maintain a certain price point that is a lot more realistic to what the buyers are expecting. In terms of transaction fell through, we are similar numbers as December 2022 at around about 74 listings for the 5 counties that we are tracking right now. The numbers are pretty low. It means that, like, transactions are actually going through, and there isn't a lot of falling through of escrow right now. All right, so now we're looking at the median price for these 5 counties. Let's take a look at Santa Clara County. We mentioned before that we peaked in April 2022 at 1.95, and it has gradually, well, I wouldn't say gradual, it was kind of coming down pretty quickly, especially around the summertime, around July, August. And then December, because it was so slow, it came down even more. But interestingly, in Santa Clara County, you see the median price actually came up a little bit slightly from December to 1.5. And we had mentioned a little bit last month as well that we did see some of the homes, we have multiple offers, although they're not aggressively way above asking price, but we definitely started seeing a lot more buyers start to come out and look at properties. And San Mateo County, it peaked in 2.25, and then it came all the way down to 1.48. It is lower than December's number, which was at 1.539. And Alameda County, we peaked in May 2022 at $1.5 million, and this month in January, last month in January, it came down to 1.0225 for their median sales price. It also came down from December at $1.05 million as well. And as for San Francisco County, it peaked in April 2022 at $2.05 million, and it dropped quite a bit to $1.385 million in January of 2023. It actually came down quite a bit. If you look at comparing to December 2022, number was 1.55, and January is 1.385. It came down almost $200,000. As for Contra Costa County, it peaked in May 2022 at $980,000, and it came down to $725,000, and also compared to December, it was at $755,000, so it came down about $30,000 for Contra Costa County. So if you look at the percentage wise, Santa Clara County, like I mentioned earlier, it actually has gone up slightly from 1.465 to $1.5 million, which was about 2.39%. But if you look at year over year, it compared to last year's number, it came down about 12.9%, which is about 13%. But if you compare it to the peak, it came down about 23%. And San Mateo County, it came down about 3.83% from last month, December. And then if you compare to last year, it came down about 18.49%. And then when you compare to the peak in April for San Mateo County, it actually came down to 34.22%. Now, Alameda County, it dropped about 2.62% from last month, and but it dropped about 14.6% from last year, and about 31.83% from the peak in May. And as for San Francisco County, this is a big one that we mentioned just now. It came down 10.65% from last month. But then, however, if you compare to last year, it only came down like 4.91%. So that is pretty drastic change. But if you look at the peak in April, it came down about 32.44%. And lastly, Contra Costa County, it dropped about 3.97% from last month and 7% from last year and 26% from the peak in May. So as you see that it has quite a big difference. Again, the pricing has gone up a lot since in the beginning of the year, and that's why it sees such a drastic change. Now, the question a lot of people are probably going to ask is that, so are we going to continue to drop even more from the peak? I think in terms of the year, like compared to last year, it's pretty we kind of expected at this range, but obviously when you compare to from the peak of the pricing, it looks quite dire because it's 20-30% of the value has been dropped. And we're going to take a look at a lot of different macroeconomic factors to see, like, maybe we can kind of based on those information and see where the market is going to go on my later slides. All right, so what happens on the battleground? Obviously, we want to share with you kind of live what's going on with the offers that have been submitted. And here are just some examples for you guys. In the city of Santa Clara, single family homes, asking price of 1.349. They received multiple offers. If you kind of just look down this column, you see that a lot of multiple offers, right? And it was sold for $1.5 million, which is, and not bad at all. It's still pretty high, $150,000 over asking price. As for townhouses, here is like they have three offers in 6 days, and they sold it to a cash offer. And this is what we are also noticing these days, is that sellers are so willing to accept cash offers, even if it is a little bit lower than a financed offer. So you see that just based on this chart, we already have 1, 2, 3, 4, 5 of these examples that have accepted cash offers instead of financed offers. And then here go Mountain View, asking price at 1.6. It did take about 20 days to receive 2 offers and ended up selling below asking price. And while a fixer at Mountain View, but is a single family house, it had received 14 offers and 55 days because they dropped the price, and the asking price dropped down to 1.5, and they sold it at 1.57. So I think if last year we had 14 offers, this would have been like $1.7 million, right? People would be, bidding like $700,000 above asking price. But in this case, even 14 offers, it is just about $70,000 over asking price. Now in Palo Alto, single family, asking $3.1 million, and they received 4 offers. They accept cash offers at 3.1. And even South San Jose, if we come down to South San Jose, for single family, still getting 5 offers in 3 days, and they accepted a cash offer above asking price. And if you continue to go south a little bit, Santa Teresa, for a condo, even though it's a condo, it received a cash offer in just 3 days. If you go to East Bay, let me skip over to San Jose Cambrian, which is also in the San Jose more southwest area, asking price about 1.4. They received 4 offers and within a week, and they sold at $1.5 million. Now, these 3 are in the East Bay area. As you see, that same thing, we're getting multiple offers, although you see that this is a longer days, but then it's also because the price have come down a little bit, and then they start getting a few offers, which in the end is still below asking price. So here you kind of give you guys a sense that there are still a lot of buyers on the market. There's still a lot of interest in coming into the housing market. It's just that buyers are a lot more conservative now, unless the house really does have everything that they want. Then the offer price could be slightly more aggressive, but otherwise buyers are still pretty conservative in terms of making their offers. All right, now what about the mortgage rates? And let's take a look at the consumer price index first. You guys probably start hearing a lot of the news or seeing all these headlines these last couple of days. Consumer price index kind of ticked up a little bit, went up to 6.4%, and the core index is actually at 5.6%, and is slightly higher than what they were expecting, but then it just didn't come down as fast. Although the Fed actually thought that the inflation probably can ease a little bit faster, so they might, even though they are still going to increase rate, but it will be probably going slower, so that it's easing some recession risk. And if you look at here from USA Today, Gregory Dacko, chief economist at Ernst & Young, said that the rise in core consumer price index last month isn't cause for concern, since the big jump in shelter prices could mean there will be smaller increases in coming months. And Dacko predicts that annual inflation will fall to 2.3% by the end of the year, which is pretty much where the Fed is trying to aim for. And the core inflation he predicts will fall to 2.8% by then. So definitely, if we are going to hit that by the end of the year, we're probably going to start seeing a lot more improvements in 2024. Now, 10-year Treasury yield last month, when we reported to you, it tumbled below 3.44%. But now this month it came back up because of the inflation data. So now went from 3.44 last month and now came back up to 3.81. And when the 10-year Treasury bills go up, then that means the interest rate goes up. So we're going to take a look at what's going on and what do these agencies think that the rate is going to move towards. Now, the only thing changed on this chart compared to last month is just the Fannie Mae one, because everyone else didn't really update their numbers yet. So they are still the same as last month. It's just that I'm still having these numbers in the parentheses to show you what they have changed from their last projections. So Freddie Mac had projected a much higher number in July 2022 versus October 22. So they believe that in 1Q 2023 now is at 6.4%, which is in line with what Fannie Mae is projecting. And the Mortgage Bankers Association is about 6.2, and the National Association of Realtors is at 6.1 for 1Q 2023. So the average of all four is about 6.23%. And now if you look at 2Q, Freddie Mac is projecting at 6.5%, Fannie Mae at 6.4%, Mortgage Bankers Association at 5.6%, and National Association of Realtors at 5.7%. So the average of all four has gone below 6%. So if you start seeing this, actually, you notice that basically they believe that the mortgage rate is going to peak by the end of 1Q 2023, and it's going to start to come down starting 2Q 2023. I think this is very, very important to know, because of the fact that, as you know, buyers are very sensitive with their mortgage rates. So definitely, you're probably going to start seeing a lot more activity starting 2Q 2023. And I want you guys to pay attention to this number here a little bit, 6.23%, which is 1Q 2023, because I want to show you this historical mortgage rates provided by Wells Fargo, Victor Chow at Wells Fargo. And if we look at the mortgage rate for January 2023, they have recorded at 6.27%. And by the way, just want to clarify one thing, is that these rates are based on conforming rate, not the jumbo rates. So this is 6.27%. If you have jumbo loan, you probably know that you're not getting you're not getting a rate as high as 6.27. You're probably in the fives range. So this is pretty much in line with what the agencies have been projecting. But I want you to take a look at that. The numbers starting from actually came down from October. October, it peaked at 6.9%, and it just started to come down to 6.27%. And on top of that, if you compare to last time, which is around the 6.3%, was in 2007. So since 2007, the numbers, the mortgage rate has been below 6.34%. I guess like the one before was 6.4 was 2006. And then from 2003 to 2005, that was kind of like the peak of the housing market at the time. It was kind of going up, and that was around like 5.8% or so. And then the last time it was at about 6.3 was in 2007. Since then, it's been below 6%. And of course, the lowest ever was in 2021, which was at 2.96%. And a lot of people who bought around this time frame, they are definitely not thinking about selling because they were able to hold on to, well, actually, not just people who bought, people who refinanced around this time frame, they're just holding on to their houses with such low mortgage rates. I'm one of those people who had refinanced during that time, and our mortgage payment have come down so much that we are not even going to be thinking about selling at all because we just want to hold on to that low monthly payments. All right, so what's going on with the jumbo rate? Because our area, a lot of the mortgage loan balance, they are all jumbo rates. So this is about 5% for 30 years fixed, and this was last month, and then this month it has gone up about 50 basis point at 5.5%. Like we mentioned earlier, the 10-year Treasury bill has come back up, so it actually went down last month and it came back up to 5.5%. All right, so I just want to share with you guys a little bit of what's going on. If you compare to the pricing in April 2022, which was the peak, this is the Santa Clara County peak pricing at 1.95%. If you had paid 20% down payment with a mortgage balance at 1.56, your mortgage payment is actually at $7,561 when the 30 years rate at the time was about 4.125%. Now, as the pricing has come down, now the median sales price about $1.5 million, do the down payment at $300,000 with a mortgage balance of 1.2. Your mortgage payment now, even at 5.5%, is $6,813. So what happens if, just saying, if in the future, let's say, I should have put down 2025 or something like that. Let's say in the future, the 30 years mortgage rate comes down to 4.5%. And you see that as a good opportunity to refinance. And at that point, when you refinance, then your mortgage payment can come down to about $6,080, which is way cheaper, obviously, compared to what you have bought if you have bought in April 2022. I think I just kind of want to show you this chart just so that I know some people are wondering if they should go into the market right now or not. I do think that the pricing probably not going to come down that much more in the future because the interest rate was so high before that a lot of people just took a pause. Literally, they're not coming out to look at properties, but right now we're starting seeing some activity. So if you're thinking about long term, like living in your property, this is where you want to start your family. I think this is a really good time for you to consider buying a property right now. All right, so the biggest question also, Bay Area housing market, are we going to crash any further? We see Goldman Sachs just came up with this. My friends shared this article with me talking about San Jose is going to be one of the 4 cities going to have this housing crash just like 2008. I think this had already happened. Home prices, they were talking about like it can be declining more than 25%. As you saw earlier, the pricing coming from the peak has already come down about 25 to 30% or so for a lot of counties. So we definitely have seen that drop already since last year. Oops. And in terms of like the tech layoffs, I know this is also a big topic with a lot of our clients right now talking about the tech layoffs. It sounds extremely, really scary. I know a lot of our clients are just not sure if they're going to have their job, so they want to take a pause. But at the same time, on the other hand, we have this other news talking about like we just added 517,000 jobs, which is way more than what they have expected. And the unemployment rate is the lowest since 1969. Just like, what is going on? So it's very confusing, I know. And that's why they started saying that, well, a lot of these tech people are being laid off, but at the same time, there are just so many opportunities out there. It may not necessarily be all in the Bay Area. It could be elsewhere, somewhere else. But at the same time, hopefully, I'm just providing some comfort to those people who are really worried about their future. There's nothing to do with whether you should buy a home here or not. But the idea is that if you are worrying about layoffs, at least hopefully this show you there is still a lot of other opportunities out there that are still needing your talent on the market. So, and the great statistics here is that 42% of those people who got laid off actually found a higher paying job. There you go. May not be here, maybe somewhere else. I don't know, could be here, but there are actually a lot more smaller company or government jobs that really need more tech workers. So I wish everybody, the best of luck in finding a new job if you got laid off. But I do believe that this is still a very good news. Even if you get laid off, you might be able to find another much better job anyways. All right. So we know that our inventory has been super tight, and then the multifamily housing, we need them to be built. And so Lawrence Yun, who is the chief economist for the National Association of Realtors, has said that because there isn't really a lot of listings of homes for sale and mortgage rate dips in future months, buyers will return. But without the supply, another revival of multiple biddings could occur again. So this is really important to know. And then you will see that there's so many conversations right now about like building. And then the Bay Areas, we're pushing to build 441,000 new homes by 2031. And that's only 8 years away. Can we do that? And the state officials have been pushing all these cities and counties to really meet these kind of home building goals. And then last week it's been like a very stressful time for a lot of these cities, 2 weeks ago, because they need to be able to submit their proposal, how they're going to be able to add housings in their respective cities. And the bulk of the new homes are set for the region's population centers near jobs and transportation, including San Jose, Oakland, and San Francisco, but suburban and rural areas also must plan for more housing. So how many homes did the Bay Area actually build in the last housing cycle? Is between 2015 and 2023, the Bay Area had permitted, meaning not built yet, permitted about 190,000 units, but they only approved 44,000 homes for low or middle income residents, which is well under half the combined target for those groups. So we are still very, very short on housing for people. So we definitely need to do everything possible to actually encourage or help our builders to build more in our area. And unfortunately, there are some areas, because they're ultra wealthy areas, for example, Los Altos Hills, they are all single family. So they really did not like the idea of building high density housing complex in their area. I'm not saying this is not right or wrong. I can understand why, you're paying so much money for that type of environment. They just want to have their own privacy, but at the same time, these towns, they are also being requested and also demanded by the state to have these housing plans and increasing housing units in their area. So it's been a really tough topic to talk about, and so continuously you're going to see a lot of news that talk about how the cities and the counties, they are all fight. In a sense, I don't want to say fighting, but at the same time, the state are really pushing down very hard for them to build, to have a plan so that we can build more and increase housing. Including San Francisco, now they're not allowing landlords to have their units vacant. If they have the units vacant, they will imply this new tax on these vacant units, and hence now landlords are suing over this new tax on vacant housing units, and it is going to be really difficult for a lot of landlords. But the purpose of this is really trying to make sure that they are filling these units for people to live in. And if you're worried about foreclosures, as you see, California, we're all the way at the bottom ranking. We have a delinquency percentage at 1.8%. And then the year-over-year change in non-current percentage is actually down by 10%. And this chart shows that in November 2022, we have about 1.8 million about non-current filings. But still, if you look at the numbers, we are pretty much in line, and it's still lower than what we had back in, let's say, before COVID, which is 2019, is at 2.2 million. So I think so far, because the pricing has gone up so much, there's so much equity that if somebody really not current on their loans, they would much rather just sell it without going into foreclosures. All right, I'm gonna go through this really quickly. Commercial real estate market has dropped quite a bit. The lending already dropped 54% less originations last quarter. And then as you see that over here, San Francisco, San Jose, and Oakland, they are still ranking the top 10 in terms of like the rental prices in the country. And in terms of the demand and supply, we know that in the whole country, we see Austin, Dallas, Orlando, and Raleigh, they have the most job growth, and they also have the most have a lot of building permits. So they are actually going to have an elevated supply and might still actually outstrip demand in those areas. So if you look at this, is the multifamily apartment units where they are building, and you see that some I highlighted because they're pretty small. I highlighted some of the California cities here, and our building and completion date expected is still very small compared to what they're doing in New York, Dallas, Austin, Washington, D.C., Atlanta, and Houston, etc. So we are definitely behind in terms of building, and hence we have much higher demand and not enough supply. All right, so East Bay multifamily report. If you look at look at the market cap rate in the East Bay, we are ranging around average about 4%, with East Oakland have the highest cap rate of 4.6%. And I highlighted Berkeley because Berkeley has about 4% cap rate, but then they have a pretty good number in terms of rental price at $2,724. Just kind of side note is that the higher the cap rate, typically you see that it's cheaper the property is, and cheaper property a lot of times could be because the rental price is a little bit lower. But in this case, even though Berkeley, we have 4% cap, their rental price is one of the highest in the East Bay area. And the rent growth also over here, that the best rent growth area is in Oakland Hills and Alameda, second by Alameda, and the third is San Leandro. And if you look at Silicon Valley multifamily, we're ranging at about mid 3% on the cap rate. And then the Milpitas and Palo Alto, I was so surprised that Milpitas and Palo Alto, they are having a very similar cap rate, but at the same time, Palo Alto, their rent price is way above. Their ranking second in terms of rental price at $3,373, while Milpitas at $2,971. And then if you look at Morgan Hill, Gilroy is at $2,439, and East San Jose is at $2,340. But the Morgan Hill, they have a pretty high cap rate at 3.9%, and also East San Jose at 3.7%. In terms of rent growth, East San Jose has pretty good rent growth at 4.32%, and they also have really good cap rates. So I thought East San Jose is actually a really good market in terms of if you're looking to invest. All right, San Francisco is a daily city. You see that is at 3.8% cap, and then their rental price at $2,581, while you see that South San Francisco at 3.5% cap, and then their rental price at pretty high is at $3,039 and $2,915 for Redwood City. And the growth for daily city is actually ranked 2 at 2.54% in the San Francisco multifamily market. So this concludes my Bay Area housing market outlook, is that we do see inflation is easing, and the rate hikes is going to start slowing down. It's not going to be like last year. That I think that really got everybody really worried about the market. And although the residential market is still going to be a little bit volatile during the first half of 2023, but we definitely start seeing positive signs in second half of 2023. Silicon Valley, we are affected by the tech job cuts, but in terms of the whole recession, most of the economists think that it's going to be mild, because a lot of tech workers actually, they will be able to find jobs elsewhere, and our job market is still doing really well. And multifamily demand will continue to be slow in 2023, and this is going to last until 2024. So if you do want to get a deal, this year might be a good time to get a deal on multifamily buildings. All right, sorry this is long, I know, and I'm going to be turning this over to Michelle. And I know, Michelle, we have so many questions for you regarding insurance. Hi, Michelle.
Hey there, how's it going?
Ooh, I feel like I just keep talking. There is so much information, and I know you have a lot of information you want to share as well, especially after this rainy season and all this fire from last year.
Oh, yeah. Well, let's dive into it because it's a lot of information to share and to squeeze it in 15, 20 minutes. It's going to be interesting.
Sounds good. And in the meantime, if you guys have questions, feel free to type it in, and we will try to answer your questions here.
All right, so let's get started. So property insurance can be so complicated, but I wanted to really break it down for you guys. Is really about property perils. When we talk about home insurance, or clients ask me, can I get a home and fire? Well, they're essentially the same thing. So your home insurance is going to really cover your dwelling, right? Any covered losses within the policy would be wind, hail, fire, water losses, and stuff like that. Then we have earthquake insurance. That's when we have earth movement, and it can cause your house or your belongings to be damaged during that earthquake. And the last is flood. The flood insurance is for inundation of a lot of water that is coming down, could flood your property, and it could damage your insides and your outside of your home and your property. So just remember, in California, your home insurance does not include earthquake or flood. All right. That is very important to know because a lot of people don't know this, and they need to know that these are the two perils that are not a part of your home insurance. Okay. One of the big things that a lot of my clients ask me is earthquake insurance worth it? Is it really worth it? Well, when you buy your home, you will get a natural hazard disclosure. It is good for you guys to review that particular disclosure. It will tell you where your proximity is to an active fault line. So if you're in, the East San Jose Hills, you're on an active fault line. Okay, so you really want to find out where your home is in the proximity of those active fault lines. Then we want to take a look at frequency of the earthquake in your area. Is there a lot? Is there one every month? Is there one, every week? What does that look like? And should we be that concerned, right? How much time has passed since the last earthquake, right? Is it one after another, the aftershocks and stuff like that? What's happening during that, time frame? Okay. Then we want to look at your home construction. Was it built in 1910? Well, the construction was completely different than if your home is now built in 2000. So we look at the construction, and was it, built with, the next one is whether the house was built with earthquake preparedness. Homes that are built now, they'll have crippling walls, you'll have the strapped down water heaters, you'll have a lot of things that will allow your house to move with the earthquake, right? When you have an older home, that's not necessarily true. And then you'll probably have a lot of settlement of the soils and stuff like that, and your house could crack. And well, there you go. Then you should literally get earthquake insurance, right? We look at the type of land. Is our land, the house that is built on, is it sand, like San Diego, or is it on rocks, maybe on the East Bay where it's, hillside, right? So depending on what that foundation is, your house is built on, we then can determine if there's something that could cause our house to crack or to slide, right? And then how much of a slope is your house on? Are you living on a hill? Is it on flat land, or is it on a hill on a slope, right? So these are things that you really want to consider when you're looking at earthquake insurance. And of course, lastly, is the cost to insure the house with that earthquake policy. Is it extraordinarily really expensive that you can't afford it? Or is it something that's within your budget that you think that yeah, I can afford it because this is where I'm located. I'm next to a fault line, and my house is not really that stable. So probability of my house going down that slope is probably great. And so it's not going to cost me that much, but it's worth me buying it. Okay. And then we're going to move on to your flood insurance. What is flood insurance? You know, most people who know flood insurance are the ones that are required to get flood insurance because their lender is forcing it upon them. When you're buying a house and you have a lender, the lender will typically run a flood determination to determine if you are in a special flood zone. And if you are, they're going to force you to buy flood insurance, right? So flood insurance is for those heavy or prolonged rain, melting snow, or coastal storm surges. It could be overflow of inland or tidal waters, such as rivers that can overflow. Could even be creek beds in the back of your house. Mud flows over areas that are normally dry, or levee breaks. Like we know here in San Jose, Morgan Hill, they were going to release the waters from the dam. Well, it went all over the place. It was just a mess, a complete mess. So it's not to say that people who are in flood zones are the only ones that are going to be prone to flood. We can be in anywhere, and you can be considered to be in a flood zone. Because look at it. Last month, we were inundated with so much rain. You can be flooded in your own way. It could be that your house was, maybe your sidewalks or your ground was going towards your house, and the water just inundated you and your house, and it just started to build upon that, right? So it is not to say just special flood zone people are, going to get flood. Even the ones that are not in flood zones could get flooded, all right? So we just want to make sure that we look at our house, we look at our situation, and what is the probability of us getting flooded, and especially after these storms, take a look at your situation. And there are FEMA policies and there's private flood policies. Private flood policies, I can average around $800 a year or even less. And for people who are not in special flood zones, could even be $300 a year. So it may be really worth your time to purchase a flood insurance and, research this. Okay. Now let's go into the types of property insurance. And a lot of people need to really understand property insurance and what kind should I get. Your first and typical and common one, if you're an owner occupied, you would get a home insurance. Okay. It's a different type of coverage because typically home insurance will have a higher personal property coverage than if you were a landlord. Okay. The next one, of course, the landlord one is mostly for investors who buy properties that are rented out. Usually the coverages are less on the personal property, but more on the coverages as a landlord, like wrongful eviction, discrimination, those types of things that are covered within the landlord realm. Condos are ones that are either townhouses or condos. Usually there might be an HOA that will cover the exterior and you're responsible for the interior. And it really depends on each HOA on how they're going to cover that particular property, both the condos and the townhouse. And I'll go over that in the next slides to kind of describe to you what the 4 different ways that we can cover a condo, all right? Renovations, you definitely want to let your insurance agent know if you're going through some major renovations, because in your home insurance policies, it will have exclusions, or they could talk about, hey, if you're under renovations, we may not be in that type of business, and we may not cover that kind of stuff. So you have to be very careful. And then if you're doing major renovations and you're moving out and it's, vacant for over, 30, 60, 90 days, there will be, clauses inside your home insurance policy saying, hey, if you're gone after, 61 days, we can actually exclude a lot of these coverages. It might be water damage, could be, certain things that renovations could cause. And they can say, hey, you know what? You didn't tell us we were under renovations, so therefore we're not going to cover, right? So be very careful. Talk to your insurance agent before you do those renovations and ask them, do I have the right policy? all right? The next policy is a vacant policy. You may be selling the house, you may be renovating the house, you may just be keeping it because you inherited the house, you have no idea what you're going to do with the house, but it's vacant. Your homeowner's insurance policy is not going to cover those vacant policies. There's so much more risk because you're not checking in the house every day. You're maybe not even there 30 days or 60 days or 90 days, doesn't matter. It's vacant, and it just carries a higher risk. So be careful with those types of properties. And the last one is, of course, in construction. This is literally taking the house maybe all the way down to the ground. It could be taking it to one wall and there's really no house left. These types of policies will help you insure the property as you go. As the frame is going up, as the sheetrocks are going in, as the roof is being put on, it will cover the home as appropriated in that scenario. And it also covers, like, materials in transition or in transit, the trucks that are, bringing in all your wood, something happens to that truck, rolls over, and you got to go buy that, material all over again. Okay. So be careful with what type of policy you're getting and make sure that you have the right one. Because I've seen a lot of homeowners that move out of the house. They don't tell me. They buy another house and they're living in that house, but they forgot to turn the first home into a dwelling fire, which is your landlord policy. Okay. So check your insurance. So going into the condo owners, these guys, you guys have to be very careful with this because there are 4 different ways in which, any insurance can cover you. The first one is all in, means that everything in exterior, interior, everything's covered to whatever was built there, and they're going to cover it to replacement costs. All right, that's number 1. Number 2 is single entity. What does that mean? It includes the unit's interior. Okay, so builder's grade, whatever the builders built. Okay, excluding any betterments and improvements. So if you improve it with granite countertops, laminate floors and stuff like that, that's improvements, and you got to cover that portion of it. Okay, bare walls, it means that it excludes the exterior and anything inside. So stud walls in, that's all your responsibility. Okay, and the last is the PUD. They only cover the common areas, but the interior and exterior, they're all yours. You have to take care of both. Okay. So be very careful, read your CC&Rs carefully, go to the insurance side. It will tell you what the HOA is responsible for, and then what the unit owner is responsible for. Okay. Next is home coverages. There's 2 types of different home coverages. One is the HO3, one is the HO5. And when we talk about the HO3, we're just really talking about open perils and named perils. So your house is typically under open perils for both the HO3 and HO5. The personal property on the HO3 is a named peril. So whatever is listed on your policy is the type of perils which they would cover on your personal property. Whereas the HO5, it's an open peril. Unless they tell you it is excluded, right, then they will, cover for all the perils. Okay. And again, your flood damage is not, covered, mold, earthquake, pollutants, insect and animal damages, and wear and tear is not ever covered in your policies. All right. Just kind of giving you a more visual side of it. Your homeowners typically covers your weather, which is your hail, lightning, and other weather events, damages to your roof, windows, sidings of your house. Right? Falling trees, branches, any of those types of things. Of course, fire, which is part like smoke, you have kitchen fires, anything that is, in your garage could, combust, they cover that. And then typically your theft and vandalism. Okay. What is not covered again is your flood, earthquake, and maintenance on your house, not covered. All right. So the dwelling coverages, this is for your landlord policies. They have the DP1s and the DP3s. Typically, the DP1s are the lowest cost, but of course, comes up because it has a lower cost. It's based upon actual cash value, and actual cash value is, what it is minus the depreciation, and then you get, the actual cost. And it's also on a named peril basis. Okay, whereas a DP3, which is mostly what investors should get for rental properties, it's an open peril. Everything's based upon replacement cost, and it's going to be the best for, rental properties. Okay. And again, just reminder, vacancy clauses, it's unoccupied for 61 days, it will reduce coverages on your policies. Right? So this is the main type of home insurance coverages that you might have. Your typical dwelling, which is your main structure, okay? Anything that's attached to it, your decks, your porches, that's all part of the dwelling coverage, all right? Other structures are your detached garage, your gazebos. They're typically 10% of your dwelling. So it's a percentage. All the carriers do for the first three coverages, the other structure, personal property, and loss of use is typically a percentage, okay? So you can't go beneath it, but you can always go above it if you need to have more coverage.
What about ADU?
ADU, if it is a unit with a bathroom, in a room, it has, if it's a separate unit, then you need to get a separate policy for an ADU. Okay. Another structure is more like something that is more a gazebo, a detached garage. It has no real function behind it. No one's living in it. When someone's living in it, it's a whole different situation. Okay. Personal liability, very, very, very important here. If anyone gets injured on your property, they find you negligible. This is what we call lawsuits, right? Anything liability and legal lawsuits, that's the area. So I always recommend 300,000, if not greater, because this is trying to protect your assets, your net worth in this particular. So always look at this particular section. And then you have your medical and your deductible. The liability, medical, and deductible, you can choose the type of coverage that you want, and it's not a percentage of any dwelling, okay? All right. Everyone's asking now, why is my home insurance prices going up? Well, guess what? Last year was the start of it. Inflation costs of building materials and labor has been going up and up and up, and people don't talk about it anymore, but supply chain issues. Big problem still. We are waiting 6 to 8 months to get any product. Could be a window, it could be a door, it could be anything, right? And then also natural hazards, disasters that have been happening for us in California, 2018, 19, 20, 21, all fires, right? 22, thank goodness we didn't have fires. So as long as we are on that trajectory of not having fires, it will help us in the long run. We've also, our increase in claims have gone up. And then of course, fraud and litigation has also been going up in the last several years. So, typical price of insurance policy has risen by 10% as of 2022, okay? All right, some insurability perspectives, when you're buying a home, things that are happening, you always want to take a look, especially your new home buyers. Previous losses on the property, right? There are some carriers do not allow for previous losses. They won't even take it at all, right? Some carriers will look at it, but then as long as it has been repaired and in good condition, they'll take it and they'll be okay with it. So take a look at the losses and you'll see that in some of your disclosures if there was any claims made on the property. Location of the property, oh my goodness, if you are living in the hills, start looking at insurance right away, because there are carriers that have literally walked away, blocked out zip codes, and they are not riding in those areas. So you need your time to go and research this. Roof, heating, and plumbing and electrical updates. Have they been done? If you have a 1910 house, you better start looking and making sure that the updates have been done, because if it's not, carriers will refuse to insure those properties, especially those electricity. When there's knob and tubes, they don't like that. They want the circuit breakers, okay? Age of home, that matters. Some carriers will not take homes less than like 1960s. They want newer homes. So that could also cause problems. And the last is designated historical homes. Most people don't realize that, but a lot of carriers will not take those types of homes. So there's only very few carriers that will actually take that kind. All right. Replacement versus actual cash value. People always ask me, how do I come up with those numbers? Well, all the carriers use a 360 valuation to do replacement costs. This does not include land. So do not mistaken that market value equals replacement costs. No, we're not looking at that. We're looking at what it will take for us to rebuild that house. So it's based upon, the amenities of the house when it was built, square footage, and all the insides and the exteriors of the house, and is how we come up with the replacement costs. And again, actual cash value is replacement minus depreciation. So, depreciation is a decrease in value due to wear and tear or age. Okay. Options for people who have home insurance that is canceled. Okay. Way too many losses, could be the houses in the, location, which is huge fires, you're getting canceled. So instead of looking at preferred carriers, you're going to have to move yourself downwards to standard carriers. Standard carriers can usually do a little bit more, willing to reach further into those fire zones. And you just got to, take a look at some of those. You might not know many of them, but you can talk to your brokers. Brokers work with a lot of different insurance carriers, and they can pretty much get down to a lot of standard carriers and find carriers that were willing to take you due to losses, or it could be location, could be age, or the historical homes that you might have. And the bottom of it all, that if nobody will take you, the California Fair Plan will take you. Okay. They don't want to be your top one to take. They want to take you only when all things fail, then they will take it. So, do your due diligence and try to get down to, before you get down to the California Fair Plan, try to find a different carrier before you get there. Okay?
I can't tell you how many times we get asked this question nowadays because of the fire situation. They have bought the house close, may not even be in the hills, just because they're close, and their policy get canceled. And it's very scary, especially for some of the if they're living in a community where they have the HOA, they have the insurance policy, and then that gets canceled. All of a sudden, they have to find something else that's a lot more expensive, which bumps up their HOA fees with a special assessment.
Yeah, and so there are some carriers that are coming back into the area. They just have to see some stability in the risk, and they may reopen those particular zip codes as long as they see some profitability in that area, or they don't see any more losses in that area. So sometimes we just have to wait for the carriers to come back. And I do have one carrier that, they are a really high-tech company, and they are like, hey, we're willing to do business in some high fire zones. We just have to take a look at the location, and then we'll let you know. But
interesting.
So this one just came out early this year. They, said, hey, we're willing to do business. And they've been doing business for the last 2 years, but now they're willing to ramp up and get to the point where they're open to the public now.
So there is a question on here. It says this person asked, how many carriers have left California, and what is the California Insurance Commissioner doing about all these carriers leaving California?
The Department of Insurance has been fighting with the insurance carriers since 2019. So it's not just the homes right now. At end of 2022, the auto insurance carriers are also leaving. So it's putting us into a very, very huge bind. It almost takes the consumers to yell at the Department of Insurance to move ahead, to, play nice with the insurance carriers, to work to, some understanding. But yeah, there are carriers that are leaving the state of California due to the massive losses, since we've been collecting them since 2018, right? We haven't stopped. And a lot of people don't understand that the homes, not only was the homes that were burning, but the autos were too. Because if I were running away from a fire with you, Helen, you and I would be in one of the car. We wouldn't take all 4 cars with us, right? We'd be like, I want to keep my eye on you. So let's get into one car and let's leave. So the house burned down, but also the 3 other cars burned away too. Right? I don't understand that. But yeah, it's going to be very interesting this year. Not only the homes, but also the autos, but there's a lot of carriers that are leaving.
Oh my goodness. tough.
Okay. Well, how do we optimize our policies? People are like, we're in this situation now. Not only our auto insurance is going up, our home insurance is going up. I always tell people bundle it. Bundle it with your, home and auto. Try to bundle an umbrella with it. If your carrier, ask them about affinity discounts. Your occupation. It might be the engineer, the scientist, attorneys, or the fire fighters. Whatever affinity discount that they might have, ask them about it. Okay. Home safety discounts, burglar alarms, fire alarms. Even if the burglar alarm is a local alarm system that you turn on, that might even be a discount. Fire sprinklers, any homes that are built now, they all have fire sprinklers, right? So just make sure that these fire safety discounts are being applied. New home buyer discounts, right? If you're a new home buyer, you have 3 years of discounts. So make sure that you tell them, hey, this is a purchase transaction. I'm a new home buyer. I want that discount. If you do any home updates, roof, heating, plumbing, electrical, let me tell you, the roof update can, shave off a little bit off of your premium. So tell your agent, hey, I just got a new roof, or I have a new heating or plumbing. I redid the whole thing. See if that you can apply a discount for it, right? And the last way is raising your deductible. Maybe you don't want to have it at the $1,000. Raise it up to 25. We want to use our insurance for the big stuff, not for the small stuff, right? So raising your deductible to 2,500 might be more suitable for you, right? As long as you can afford it. So everyone has their own personal feeling about, deductibles, but just look at your situation and see if that's worth your time. Okay.
We have a question that from Mercy asked, how to receive the replacement cost for a property?
Your insurance agent should be able to give you a replacement cost calculation. So it's, they should be able to give you the, printout of it, how they made that calculation for you. Because I do that for all my clients when I'm, calculating the replacement cost. And, usually I'll send them a PDF of, that particular house, and they, so you can review it. Sometimes like Allstate will have like, when your renewal comes up, they might have that replacement cost pages inside your renewal. And then you want to look through it and make sure that it is correct. It's not 2 sliding glass doors, it's 1. It might be, they don't even have skylights in there, but you have 3 skylights. You want to make sure that it's in there. So make sure you're reviewing things with your insurance agent, and making sure that the information is correct. Even the square footage could be incorrect, right? You might have added a square footage, right? And you didn't tell them.
And if you have remodeled your home, then you need to talk to your agent again and to update your policy.
Yeah. And a lot of people did that during COVID, right? They were like, I want to repaint this. I want to add this. I want to, redo my sliding glass door. I want to add this because I need more room because I want my own office now, right? So if you've done those things and you didn't tell your agent, you better go and tell them, because let me tell you, inflation is killing all of us, but it's also going to be, if you don't look at your policy, you might be short, right? You're not going to have enough coverage, and then you'll have half a house left. So.
And someone asked, what exceptions should we be on the lookout for?
Exception as in what?
Yeah, if you don't mind, elaborate on your questions. What kind of exceptions are you referring to? Well, hopefully they will type it in. But this is a lot of information. All I kept thinking about is that, okay, I bet a lot of people didn't know that they don't have flood insurance. And actually, if you don't mind to clarify one thing, is that we just had rain, right? And then that caused all this flooding. But then I know you mentioned that your regular home insurance policy, besides fire, there is some kind of weather related type of coverage as well.
Yeah. So if you have we've got a lot of rain and it damages your roof, pops a leak and stuff like that, then that's covered, right? But when we're talking about flood, it's really about the water collection, right? Where there's so much water inundating your property, where, now you've got flooding into your basements and, or it's rising up into your house, right? I had one client call me up and, oh my God, his house the first floor was flooded, because he lives right next to a river. The river rose up and it went right into his house. So that's flood, right? But when we're talking about heavy rains coming down, breaking a leak in your roof, that is part of your home insurance, right? Or if your water leak happens because of pipe breaking in your house, that's part of your home insurance, all right? Or it could be hail damaging your roof and punching a hole in your roof. That's part of the home insurance.
So even though the flood caused by weather-related rain, but that does not cover because it's actually the water rising up and it's not just causing damage for like leaks and stuff like that.
Yeah, so it depends on how it's coming in, right? But if it's a lot of water inundation, right? Water runoff or collection of water that is around your house, that's typically your flood insurance. Okay. But anything else is typically your home insurance that would start covering.
Got it. Okay, so we do have a clarification here. He or she meant exceptions being items that are not covered.
Okay, so yeah, so it would be all dependent on the type of policy that you're getting, right? Like the DP1 usually has named perils. So inside your policy will tell you exactly what is covered, right? Whereas the DP3, when it says open perils, they'll tell you exclusions, right? They'll tell you what those exclusions are. So every carrier has their differences in their policies. So you want to make sure you go back to your policies to read, what they are. Okay. I can't tell you, like in general, like most general home insurance policies are your fire, your wind, hail, storm type of stuff, right? The acts of God typically is covered. But the exclusions might be, other things, right? So yeah, it's a long list. It'd be a nighttime reading scenario. But
yeah, and for example, there are some homes that have the wood shaker roof. And we see that a lot of insurance companies, they say like, no, we don't insure the house with a wood shaker roof unless you replace it.
Yeah, that is a big issue, especially here in, Santa Clara. We still have a lot of old homes that have the wood shake roofs and stuff. Definitely in the past 5 years, a lot of carriers have walked away from wood shake roofs. They want nothing to do with it, right?
Even if you're not in a high fire risk area.
Doesn't matter. They just don't like it. Yep. They just really don't like that because it's just, there's too many things that could go wrong with a wood shake roof, too much risk for them. They know this statistically, that is, more losses than they want to take. So there's still a handful of carriers that are willing to take it as long as the roof was inspected or it was new. So you have to be very careful with that. You have to talk to your insurance agent about it. What are their underwriting guidelines around that wood shake roof. And, if you definitely have one and they don't take it, and when you do replace it, then you might have like 10 carriers. Right now, there's like, for me, I only have a couple carriers that are willing to take that wood shake roof. And it really narrows the scope for buyers in general, right? You just don't have that ability to look at all the other carriers, right? But so it's important to, if you have one of those wood shake roofs and they're older, just get rid of it, get a new roof. Then you have like 10 carriers that are willing to take you.
It is important to know this before you buy a home. We usually mention that to our clients is like, look, you might have a hard time finding a carrier who is willing to insure this house because it had a wood shaker roof. So that's a really good tip. And then kind of want to go back to that high fire risk area because I know this is a big topic. So many people have their insurance policies canceled, no matter if it's a single family house or condominiums, in the complex. So you mentioned earlier that they should, of course, start looking around, but I feel like a lot of people just don't know who those carriers are, right? They just know the big names and they're like, who else should we call? So what would you suggest them to do?
Definitely, so State Farm is one carrier that has been doing quite a bit of high fire, okay, mostly owner occupied. Okay. But you have to double check with them and make sure that maybe their guidelines have changed, right? Unfortunately, for people who are in these zones, you're going to have to do a lot of shopping. You have to do a lot of reaching out, talking to your friends, asking them, who their insurance agents are, maybe even talk to your neighbors, right? That are going to be your new neighbors. Where are they getting their insurance, right? And, if you don't know the brokers, get to know a broker because they'll have a lot of resources, right? Because they are working with a lot of different insurance carriers and they can give you a lot of different options. And of course, once you get down to it and you lose all the options, then the California Fair Plan is going to be the last resort, right? So you just have to have an arsenal, the real estate agents, mortgage brokers, they all have to have some arsenal of insurance agents out there that they can pull from to being their resources, right? So I have like one agent who sends me all bunch of properties all over Santa Cruz. How about this one, Michelle? How about this one? And, sometimes I'll do the shopping and I'll reach out to my colleagues who are part of Farmers and State Farm, and I'll ask them, I say, hey, can you guys do this area? Is this zip code okay with you guys? They'll let me know. And then I'll put the client or the realtor in touch with that colleague of mine, and they can further conversation with them. So
it's very heartbreaking. And can you give a sense for those people, maybe like, hey, if you regularly, we see a lot of insurance policy, maybe, $1,000 range, if they cancel and you have to really go to California Fair Plan, how much more are they expecting?
So it depends on that location. It can go up to, I've seen like 2, 3, 4,000. And that's just remember, California Fair Plan is only about the fire, okay? The fire portion of it. So you would have to bring up the companion policy, which is what we call the difference in condition. They will cover everything else other than the fire, okay? So you have to put these two policies together to make it like a regular home policy. Yeah. So it's not just the California Fair Plan, which is, $2,000 to $3,000, $4,000, but then you have to bring in the difference in condition companion policy, which could be another $1,000 to $2,000, depending on the carrier. And again, they all look at the dwelling coverage, they look at the location to come up with that actual premium, right? So, so you're not just buying the California Fair Plan, you also have to get the companion one. Just to make a note of that one.
I think it is really important to note is that really talking to an insurance agent like Michelle can really explain these options and making sure you are well protected, because like so many times we just hear our clients like, oh, we're just picking the cheapest one. So, well, did you look at the policy? Did you look at what's covered and what's not covered? Are you sure that's enough? And really not just looking at how much premium you're paying, but really looking at if you're well protected or not. Real estate is just very expensive, and it is very expensive to lose if you don't have a appropriate policy that covers everything. So I know there are still probably a lot of questions. I still have a lot of questions I want to ask, but it is 5:16 now. We started late and we ended a minute late. But thank you so much, Michelle, for coming on and explaining insurance policies. And maybe we need to do another segment where we just talk about flood only, talk about fire only, and talk about earthquake only.
For sure.
Well, thank you. And thank you everyone else for attending this. And I hope I'll see you guys next month. See you later.